Hello and welcome to this week's edition of Echo45 Advisors Market and Economic Update. In this video, we'll discuss the rising national debt, which has nearly quadrupled since 2008. Budget deficits continue to grow as government spending outpaces tax revenues, with projections showing interest payments could reach $1.71 trillion over the next decade. Despite debt concerns, U.S. Treasuries remain the global standard for stable assets, and markets have historically performed well regardless of debt levels. The U.S. dollar also continues to be the world's reserve currency. Over the next few minutes, we'll discuss the factors that go into the national debt and provide perspective on what this could actually mean for the economy and for investors. First, this chart shows the total and net federal debt relative to GDP. The net debt excludes federal debt that is held within the government. Federal debt as a percentage of GDP has risen over the past decade. Despite the significant growth of the national debt since 2008, markets have performed well over this period. Additionally, the $31.4 trillion debt ceiling is suspended until January 2025, at which point congressional approval would be required to further raise or extend it, something that has happened many times in recent decades. Many investors worry about the limits of this borrowing. Unfortunately, there are no hard and fast rules or examples. Japan, for instance, has operated with debt to GDP levels over 200 or even 250% over the past 2 decades. Their experience isn't quite comparable due to their older demographics and less diverse economy. It's also important to note that the markets and diversified portfolios have done very well over the past 2 decades as the national debt has risen. While growing debt is a problem, it's also important not to overreact with your portfolio. Next, this chart shows that recurring budget deficits are what drive up the national debt over time. Historically, the U.S. has run a budget deficit in most years, meaning the government expenses outpace revenues, as this chart demonstrates. Although tax revenues have risen as a result of economic growth, both mandatory and discretionary spending have outpaced income. Deficits tend to spike during recessions and wars, with the recent highest deficits occurring during the 2020 pandemic and the 2008 global financial crisis. While current deficit levels are significant, historical patterns show economic stabilization typically improves fiscal situations over time. Unfortunately, this does not mean that we will see surpluses anytime soon. The last surpluses occurred during the Clinton administration and the Nixon administration before that. Finally, this chart shows federal interest payments, with the blue showing payments in absolute dollars and the yellow showing them as a percentage of GDP. Future projections are illustrated by the dotted lines. As federal deficit spending continues, interest payments are on track to reach $1.7 trillion in 10 years, though neither major political party is prioritizing the issue. Despite concerns, U.S. Treasuries remain the global standard for stable assets, with 2/3 of national debt held domestically. There could certainly be a point where treasuries become unattractive, but this hasn't happened yet. In fact, when there is global economic uncertainty, investors still tend to flock to U.S. Treasuries as a safe haven asset. We understand that the national debt is a challenging and worrisome issue, but historical market performance serves as a reminder that debt levels and fiscal policy alone should not drive investment decisions, since the market can thrive in spite of both of them. We hope you found these insights helpful. If you'd like to discuss this topic in any more detail, please don't hesitate to reach out. We look forward to speaking with you soon.